Gordon Gekko once said that greed is good. Well, this might be the goodest market ever. Hi there, everyone. Welcome to the Traders Circle Weekly Market Update. Today is Tuesday, the 5th of March. And before I begin, you do need to be aware that whatever I say is general advice only. It does not consider your personal financial circumstances, and you have to decide if it's appropriate for you. So the markets have been driven higher by many different things. At the end of last year, it was hopes around rate cuts early in 2024. But increasingly it's been around a belief that AI is going to lead to huge productivity gains for stocks around the world. You're hearing all the bullish talking heads say how AI is going to lead to increased earnings for just about every business, from real estate investment trusts to retailers to even miners and things like that. Now, I do agree that there's definitely many applications for AI, particularly in things like financial services. If you're a bank, you're looking to approve loans. If you're an insurer, looking to do calculate insurance premiums and things like that, definitely AI is going to be a boon. But I think the market has dramatically overestimated how much your average company is going to benefit from the AI boom. And so we've seen a revision higher in earnings forecasts for a lot of businesses, particularly in the US, based around growth in earnings from AI, or at least reduction in spending, reduction in costs from AI. And I really do think that the market has perhaps got a little bit ahead of itself in forecasting these things. This is the early revision period, and oftentimes early in the revision period, earnings are revised higher, and then over time they get dragged back down. And I suspect towards the coming months, we're going to see those earnings forecasts revised lower and lower and lower. So while AI has been a big boon for markets, and indeed it was a fantastic report from Nvidia that allowed markets to reach another leg higher in the current upwards movement, whether or not it's going to be enough to drive things even further higher from here, I'm not sure we're going to be able to see that. I think we'll need to see some further positive news. Another Nvidia report, obviously that's not going to happen anytime soon, but something like that to create that extra leg, and I'm just not sure where it's going to come from. I just can't see the source that it might come from. So while markets are sort of giddy on the AI hope, I do think it's something to watch out for. Some of these stocks that they've been sort of forward forecasts of huge reductions in costs, huge earnings growth. I think we really need to start to question those forecasts. Definitely Nvidia still selling the picks and shovels. Definitely data centers filling up with increased numbers of GPUs, but whether that's going to translate to your retailer down the street selling more TVs is another question. So that is something I think is worth watching. It's not going to be a near-term driver on the market, but it is something to pay attention to moving forwards. Something that is a near-term driver for the market will be CPI numbers. In fact, US February CPI data will be released on the 12th, so that's next Wednesday, I believe. Next Wednesday our time. CPI growth was elevated in January. It was higher than expected, and that really pushed the rate cut timetable out for 2024. In fact, at the time, many were still expecting we were going to see US rate cuts in March, and they've been pushed all the way out to June now. The unfortunate reality for this story is CPI has been sticky, other economic measurables have been strong, and if they continue to come in at the current rate, even June I think will start to be a questionable timeline. So if that CPI growth is stronger than expected, I do think there's a big risk to the downside for markets. I do think we start to look towards the second half of the year for the first US rate cuts. But similarly, if that US CPI growth is in line or lower than expected, it could provide a boost for markets. It could solidify that June rate cut timetable, and it could encourage people that we're going to see a soft landing with rate cuts at least in the first half of this year. Another thing to make note of on the CPI front, or at least the interest rate inflation front, is we will see Fed Chair Jerome Powell speak tomorrow night on his view on the rate cut story moving forwards, the battle against inflation, and that'll be a big key in terms of how the Fed is thinking, whether they want to see further weakness in CPI, CPI start to come down further. And I suspect that's the narrative he's going to continue with. And that's really what all the Fed members have been saying recently. CPI growth is still too strong. Economic data, economic growth is still very strong. we're going to wait a bit, we're going to keep rates at the current level, no more rate rises, but we're not going to rush to cut rates. And I don't think there is any rush to cut rates, to be honest. The worst thing that could happen for policymakers around the world is that they cut too early and that inflation reinflates. And I know it seems like an unlikely thing at the moment, but if it does, it means that a lot of the hard work that we've sort of all done, basically, we've all suffered through, will be undone. And so they don't want to cut rates too early and risk a reinflation scenario, because that will dramatically prolong the battle with inflation, dramatically increase the time that we have high interest rates, and probably cause a higher terminal rate than we were initially expecting. In terms of Australian data, though, Australian data has been a bit weaker than that of the US. Our inflation data most recently in the weekly inflation or the weekly price data readings has been coming down. Other Australian economic data has been quite weak in the form of retail sales and other economic data. It's just been a bit underwhelming. And I really do think that, look, our RBA will never jump the gun. I don't think they'll ever be willing to cut rates before the US, but I really think there's a chance that we're put in a situation where they're forced to consider acting before the US. Like I said, I don't think they have the gumption to do so, but there is a chance that our inflation is back within target range, our economic data is significantly weaker, and that the US is still holding strong. And I don't think that scenario is too unlikely, and the RBA may be confronted with that situation, before the middle of the year. We've got to keep in mind that in the US, a lot of residential mortgages are done at fixed rates up to 30-year periods. A few years ago, you could get a 30-year fixed rate mortgage in the US for less than a 3% interest rate for 30 years. And so the transmission effect of the higher interest rates might be a lot slower acting in the US than it is here in Australia, where a lot of our mortgage rates are variable, or at least if they are fixed, only fixed for a short-term period of time. And so we've got a lot of homeowners, a lot of mortgage holders here in Australia who are really feeling the pinch of the higher interest rates, but in the US, a lot of them still haven't felt the pinch because they're locked in at low fixed rates. And again, we're seeing that sort of manifest in sort of strange outcomes, such as the transaction volumes in the US housing market are extremely low. And that's just because you've got all these borrowers who are locked in at low rates. Why would they sell? Why would they move? Why would they refinance? They're essentially locked in, and that means they're not going to take any action whatsoever. So that transmission might take a lot longer for the US, and I suspect it could cause a scenario where our RBA has a difficult decision. Do we go it alone? Do we cut rates first? And like I said, I don't think they'll have the gumption to do so, but it could be something they're forced to decide on in the coming months. Finally, I wanted to touch on China. We've seen the Chinese 2024 growth forecast released today, and they've held boldly at 5%. Officially, they grew at 5.3% in 2023, and they say that we're going to maintain that current pace of growth. We're going to do extremely well again this year, and things are going to be great just as they were last year. Unfortunately, things weren't that great last year. Third-party independent analysis suggests that China might be growing as slow as 1.5% per year, as opposed to that 5.3% they reported. We're seeing issues in their construction sector. We're seeing issues in many sectors. We're seeing issues in youth unemployment, so much so that they've stopped reporting on youth unemployment because the numbers were so great. The Chinese economy is not growing at 5.3%, and they are unfortunately seeing a sluggish period of economic growth. This 5% target is interesting, and it might suggest that they're going to look to do further stimulus measures this year, lest they look silly with weaker than forecast, weaker than official growth when the third-party numbers come out. So already we've seen cuts to key lending rates in China. We've seen some stimulus measures announced around guaranteed floor prices for some industrial products and things like steel. Whether or not they go further again, I suspect they will, and I think we'll see further stimulus measures announced from the Chinese economy, from the Chinese authorities, in the coming months. That could have ramifications for Australian miners, Australian commodities producers. We've seen iron ore really struggle across the past sort of 2 months. Start of this year, it's fallen about 12% since the start of January. The falls really accelerated in February with inventory data not looking particularly good. And so if there is stimulus and we can see a bit of a rebound in some of these key commodities, maybe we'll see a bit of a floor reached for some of the miners, which have been falling for the past couple of months. You know, BHP, Rio Tinto, they're each off a fair bit from their highs at the start of the year. The other thing worth mentioning there is they will both pay a dividend on Thursday morning, and they will both obviously fall roughly the dividend amount on open, so their share prices are likely to go even lower from here. The one thing that has looked a little bit more positive over the past couple of weeks has been lithium. Lithium prices seem to have found a bit of a floor across the past couple of weeks. We've seen prices for just about every lithium market really start to tick up, and in fact those lithium prices are now up for the last 2 months on just about every lithium market, not just your hydroxide, not just your carbonate, but even on things like spodumene and some of the sort of less refined lithium products. We've seen a bit of price action on our lithium producers, but really given the levels of short interest, I think there could be further upside on those lithium miners. So Pilbara Minerals, Mineral Resources, even things like Liontown, Ioneer, some of the smaller guys, I do think there's further potential upside, just because lithium can be a very, very long trending cyclical market, and if we have reached the floor and if we are about to see further upwards movement, I think there is a lot of upside potential in those miners. An interesting fact there is in 2023, about 1/5, 20% of cars produced globally were either electric vehicles or were hybrid vehicles. So let's have a quick look at the charts for this week, guys. This is the XGO, the top 200 stocks by market capitalization in Australia, and it's been on this uptrend since the end of October. Really has been a really strong period of gains. However, if you look, the peaks have been getting a little less steep each time. The first couple of months we jumped extremely strongly, but the gains are definitely starting to slow. This could be a sign that this trend is going to sort of shallow out or even come to an end. But obviously it's too early to say. So we reached an intraday all-time high yesterday. We weren't able to hold on to that. We closed lower, and today we've seen a lower close as well. If we do see a lower move in the US tonight, I would not be surprised at all to see our market move back to its trend line here. And that would come in around 76.50 roughly if it were to hit it tomorrow. To do that though, we'd first have to break back below 7,700, and that could be a bit of a sticking point as well. Like I said, there's plenty of dividends coming out on Thursday, Rio, BHP, also Woodside, and a few others. And that day alone is, I think, somewhere between 30 and 40 points of dividends just on that day alone. So that would push us back below that 7,700 and potentially staring at that trend line around 76.50. Overall, though, there hasn't really been a technical indication that the trend is going to break just yet. So at the moment, we're still just sort of waiting for that signal. If we have a look at the US markets, this is the S&P 500, their largest index, most broad-based index, and we can see that on Friday it did reach a new all-time high, but it wasn't able to extend that overnight. It did try to, but it pulled back and it closed flat. If they see a pullback, the previous all-time high at 5,100 could act as support, and if that breaks, we could see a move back towards the longer-term trend line. That would intersect at roughly 50-50 index points. If they do show a bearish signal tonight, a bearish bar, we will be seeing an evening star pattern form at the top of their range, and that's sometimes seen as a bit of a reversal pattern. So it would indicate that we're going to see further selling. Again, it's a little bit hard to forecast where they might fall to, because the first target and the most prominent target is the longer-term trend line, and that's not really very far away at all. That trend line would have to break before further selling looks likely. Like I said, there's plenty of data coming up in the next 2 weeks. We've got Fed Chair Jerome Powell testifying on Wednesday night. We've got the US CPI reading for February on the 12th. I think that's next Tuesday night, next Wednesday. And there's a bunch of other stuff as well, local data in particular. So our market, US markets, could look completely different at the end of next week. So I will wrap it up there for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe. We're pretty much on 500 subscribers. Hopefully, if you do click subscribe, you could be the lucky 500th. So, that could be a special milestone that you and I could share. I'll see you guys next week. Bye for now.